Every major economy crashes on an 18-year clock, not approximately. Exactly. We are currently at stage 4 of 5, and the asset stripping is already underway. Here's what that means for your net worth. Picture a central bank conference room sometime in 2005. The models are green. Credit is flowing. A junior analyst flags that land prices have detached from incomes by the widest margin since 1987. The report gets filed. The cycle continues. 3 years later, $11 trillion in household wealth evaporates. The same firms that underwrote the boom buy the wreckage at 50 cents on the dollar. Then rates drop, prices recover. A new generation enters the market, and the clock resets. This pattern appeared in 1907, 1926, 1944, 1973, 1989, and 2008. The question is not if it happens again. It is whether anyone notices stage 5 before it looks like prosperity. This is stage 1, inflating. And before we explain the mechanism, here is what it costs you personally. Every dollar of wealth you think you are building during this phase is borrowed from the next phase, when the margin call arrives. The boardroom knows this. The household does not. Let me be completely clear. What we call a housing boom is not prosperity. It is a credit-fueled collateral overvaluation event disguised as prosperity. The lever is deceptively simple. Cheap money floods into the one asset that cannot be produced in greater quantity. Land. Here is how it works. The central bank, acting as a settlement underwriter for the entire economy, sets interest rates below the rate of land price appreciation. When money costs 2% and land is rising 8% annually, the trade is obvious. Borrow, maximum. Buy land. Hold. Every participant who enters early wins. That winning creates demand. Demand pushes prices higher. Higher prices validate more lending. More lending creates more demand. The feedback loop is self-reinforcing until it is not. But here's the problem. This only works because land supply is fixed by zoning covenants, which are artificial scarcity structures maintained by the very political institutions that landholders control. If land supply could expand freely, prices would correct. It cannot, so they do not. Now picture the bank credit committee early in the cycle. Rates are low. Defaults are near zero. Every loan issued against land collateral looks clean on paper. The risk models are backward-looking. They show only the appreciation of the prior 5 years. The committee sees no warning. The window opens wide, and vendor financing, which is forced lending against a fixed supply asset, flows into the market at scale. Here is the historical mirror. Following the savings and loan crisis bottom in 1991, the Federal Reserve held rates low throughout the mid-1990s recovery. After the dot-com crash in 2001, rates dropped to 1%, the lowest in a generation. Mortgage origination exploded. By 2005, land prices in coastal U.S. markets had risen between 80 and 120% in 4 years. Japan ran the same sequence from 1973 to 1985, with land prices in central Tokyo tripling before the second acceleration phase began. The clock was running in both cases. Nobody announced it. So what does this actually mean for you? If you are a first-time buyer watching prices rise 10% per year, every year you wait costs you more. So, you enter, at peak leverage, on a mortgage sized to your maximum qualifying amount. You are now the most vulnerable participant in a system that was designed before you arrived. The second-order effect compounds the illusion. Construction booms. Employment in real estate, finance, and building trades surges. Tax revenues rise. Politicians call it a strong economy. The correlation between land price inflation and GDP growth is so consistent that policymakers mistake the symptom for the source. That misidentification is precisely what prevents the fix. You might be thinking, prices rose because of real demand, population growth, limited supply, people genuinely wanting to live there. That is partially true. And it is the most dangerous half-truth in the entire cycle. Real demand exists. But real demand does not explain why prices in the same city double in 4 years, and then drop 30% in 18 months. The population did not have. What changed was credit access. When the cost of vendor financing changes, everything built on it reprices. The demand was real. The price was a credit illusion. That is stage 1. The window is open, credit is flowing, and everyone who entered early looks like a genius. Stage 2 is where the room fills with people who should have waited, and did not. We have now entered Stage 2, overextending. And here is what this stage costs you before we go any further. This is the phase where your neighbors become your competition, and the bank becomes your enemy dressed as your partner. Overextension happens when the feedback loop of Stage 1 pulls in every participant who was previously too cautious. Speculation goes mainstream. The asset class stops being an investment. It becomes a religion. Here is the historical mirror. Britain, 1986 to 1989. Following the deregulation of the financial sector in what was called the Big Bang of 1986, mortgage lending expanded to self-certified borrowers, interest-only products, and 100% loan-to-value ratios. By 1988, UK house prices had risen 25% in a single year. Every cab driver, every pub conversation, every dinner table, property. The same dynamic played out in the US from 2003 to 2006, when subprime origination reached $600 billion annually, and loans with no income, no job, and no assets were standard product. Here is how the mechanism actually works. Stage 2 is the migration of credit standards downward. Early cycle lending goes to qualified borrowers. Mid-cycle lending goes to borderline cases. Late cycle lending, the overextension phase, reaches households that can only afford the monthly payment at current rates, with zero buffer for anything else. Simultaneously, the product mix shifts. Interest-only loans, adjustable rates, extended amortization periods. Monthly payments are minimized to maximize the loan size the borrower qualifies for. What looks like affordability is structured fragility. One rate movement breaks the position entirely. Now picture the credit committee from phase 1, but later in the cycle. Origination volumes are the only metric being tracked. Loan officers are hitting records. Risk models remain backward-looking, CATs showing only the appreciation of the prior 5 years. The room is not worried. The room is celebrating. Here is what this means for you specifically. If you bought during Stage 2, you are holding the most leveraged position, at the most expensive price, on the worst loan terms, at the exact moment the cycle is about to turn. Your equity is theoretical. Your liability is contractual. The second-order effect reaches beyond individual households. Investment banks package these vendor-financed mortgages into securities. Collateral overvaluation events are pooled and sold to pension funds and sovereign wealth funds worldwide. The risk is now globally distributed, which means when the margin call arrives, it does not stay local. Your retirement account is holding exposure to someone else's adjustable rate mortgage in a city you have never visited. You might be thinking, the banks would not lend this much if they thought it was going to collapse. They would lose money too. Here's the problem with that assumption. The banks do not hold the risk, they originate the vendor financing, collect the fees, package the loans into securities, and sell the exposure to your pension fund. The bank's balance sheet is clean the moment the mortgage-backed security is sold. They have every incentive to originate at peak cycle and zero incentive to stop. The loss lands elsewhere. It always lands elsewhere. And here is where it gets worse. The entire Stage 2 structure depends on one assumption holding. Rates stay flat or fall. Every model, every risk committee, every origination decision is premised on this. The central bank has a single tool it uses when inflation rises. It raises rates. That is the covenant breach trigger. And it is already loaded. That is Stage 2. The book is full, the risk is distributed, and the room is celebrating record origination. Stage 3 does not announce itself. It arrives as a single number on a central bank statement, and everything built in Stage 1 and Stage 2 reprices within weeks. This is Stage 3, triggering. And here is why this is the most expensive 90 days of your financial life if you are caught inside it. The margin call does not arrive as a crash. It arrives as a policy announcement, a rate hike, a number. By the time it feels like a crisis, the covenant has already been called. The central bank raises rates because it must, whether from inflation, or overheating, or political pressure. It does not matter which. The trigger is pulled, and every position built in Stages 1 and 2 reprices in sequence. Here is the historical mirror. The Federal Reserve raised rates 17 consecutive times between June 2004 and June 2006, moving from 1% to 5.25%. The first foreclosure filings appeared in late 2006, before any public acknowledgement of crisis. In Japan, the Bank of Japan raised rates in 1989 and 1990 explicitly to cool land speculation. Tokyo land prices peaked in 1991 and fell for 14 consecutive years. Same trigger, same mechanism, different decade, different country, identical outcome. Here's how the triggering mechanism works. It moves in three waves. Wave 1, adjustable rate mortgages reprice upward. Monthly payments increase between $300 and $600 on median loans. On borderline borrowers, the ones originated in Stage 2, miss first payments within 60 days. Wave 2, falling transaction volume removes price discovery. Sellers cannot find buyers at prior prices. Appraisals fall. The collateral that secured the vendor financing is now worth less than the loan balance it was written against. Wave 3, bank balance sheets show impairment. Credit standards tighten, new origination collapses. The feedback loop that built Stage 1 now runs in reverse, at 3 times the speed. If you understand nothing else, understand this. On the median U.S. home in 2007, a 2% rate increase translated to $780 more per month in mortgage payments. Not per year, per month. For a household already at maximum qualifying ratio, that is the difference between current and delinquent. That is not an economic statistic. That is a foreclosure notice arriving in an envelope. Picture the central bank conference room in 2006. The inflation data is clear. The mandate requires action. Rate hike approved. Markets absorb it. Another hike, then another. Somewhere inside the mortgage book, adjustable rate loans are repricing automatically. The households holding them do not know yet. Their next statement has not arrived. The second order effects cascade fast. Construction employment collapses within 6 months of the trigger. Financial sector layoffs follow. Consumer spending contracts as home equity extraction, which had been funding $800 billion annually in consumption at peak, disappears entirely. GDP falls. The media calls it a recession. The balance sheet calls it a liquidation event. You might be thinking, the government will intervene. The Fed will cut rates before it gets this bad. Here is the problem. By the time rate cuts are politically approved, the damage to Stage 2 borrowers is already done. Foreclosure proceedings take 12 to 18 months to complete. The rate cut arrives after the collateral has already been seized. The rescue in Stage 4 is designed to stabilize institutions, not reverse the household balance sheet. Destruction already recorded. The cut saves the system. It does not save the borrower. Now we have to address the elephant in the room. The one mechanism that could have broken Stage 3 was a debt restructuring program that wrote down principal rather than foreclosing. It was proposed in 2009. It was rejected. The reason given was that it would impair bank balance sheets. The covenant protecting institutional capital took precedence over household survival. That was not a policy failure. That was the term sheet being enforced. We have now completed 3 of 5 stages. The trigger is pulled, the margin calls are running, and the balance sheet destruction is already recorded. Stage 4 is where it gets clarifying, because the money does not disappear, it transfers, and the people receiving it were ready before Stage 3 even began. We are currently in Stage 4, stripping. This is the stage we are in right now, and here's what that means for your housing costs for the next decade. The assets that households were forced to surrender in Stage 3 are being reabsorbed at crisis floor pricing by institutional capital that waited for exactly this window. Your neighborhood is being repriced, not by the market, by a balance sheet. Here is the historical mirror. Following the 2008 crisis floor, institutional investors, including Blackstone, Invitation Homes, and dozens of private equity vehicles, purchased foreclosed single-family homes at between 30 and 60 cents on the 2006 dollar. Blackstone alone spent $10 billion acquiring approximately 80,000 homes in 4 years. In Japan, after 1991, foreign investment funds acquired commercial real estate at between 20 and 40 cents on the 1989 price. Asset stripping following a forced liquidation event is not opportunism. It is the business model. Here is how the stripping mechanism operates. It runs on 2 rails simultaneously. Rail 1 is direct acquisition, buying distressed inventory at crisis floor pricing. This compresses the supply of available homes for sale, accelerating price recovery for the acquirer's own portfolio while it is still accumulating. Rail 2 is the covenant restructuring, the government rescue that flows capital to financial institutions, recapitalizing their balance sheets so they can originate again. The Troubled Asset Relief Program, known as TARP, deployed $700 billion to recapitalize banks. The Home Affordable Modification Program, designed to help households, modified approximately 1.8 million loans. 10 million foreclosures were recorded during the same period. The math is not ambiguous. Institutions were rescued at par. Households settled at crisis terms. Picture a private equity investment committee in 2010. The slide deck is straightforward. 80,000 foreclosed single-family homes available in target markets. Acquisition price 45 cents on the peak dollar. And stabilized rental yield between 6 and 8% annually. Hold period 10 years minimum. Exit either as a publicly traded real estate investment trust or sold back into the next cycle's appreciation wave. Deal approved. Trucks start moving. This is the part that should concern you. If you rent today in a market where institutional buyers absorb post-crisis inventory, your landlord is a corporation whose cost basis is 40% below current market. They have pricing power you cannot negotiate against. Rents in markets with the highest institutional ownership are running between 25 and 40% above pre-crisis levels, adjusted for income. You are paying the annual yield on someone else's crisis window acquisition. The second-order effect is permanent, not temporary. The absorption of distressed inventory by institutional capital removes it from the owner-occupier market on a structural basis. The U.S. home ownership rate peaked near 69% in 2004. It fell to 62.9% by 2016. That 6-point drop represents millions of households repositioned permanently from owners to renters, paying monthly yield to the institutions that acquired during Stage 4. The wealth transfer compounds annually. It does not reverse on its own. You might be thinking, institutional buying is a small fraction of the total market. It cannot really move the needle. Here is the problem with that assumption. In a distressed market where transaction volume has collapsed 60%, institutional buyers represent a disproportionate share of actual closed sales. Their pricing sets the comparable. Their hold decision sets supply. A buyer with a $10 billion acquisition mandate does not need to buy every house. They need to buy enough to control the price signal. The elephant in the room is this. The Stage 4 stripping mechanism is politically visible in a way prior stages were not. A windfall acquisition tax or a first right of refusal mandate for occupier buyers during crisis windows would slow institutional absorption significantly. No major economy has implemented either at scale. The political covenant holds, the acquisition continues. That is Stage 4. The transfer is recorded, the rentals are stabilized, and the clock is advancing. Stage 5 is what they will call the recovery. Here is why that is the most misleading word in the entire cycle. This is Stage 5, resetting, and this is the most dangerous stage of all. Not because it is painful, also because it looks like relief. The rate cuts arrive, prices stabilize, employment recovers. Every headline calls it a recovery. What it actually is Stage 1 of the next 18-year cycle beginning. The covenant is renewed, the window reopens. A new cohort enters, unaware that the price they are paying is the acquisition cost for the next Stage 4. Here is the historical mirror. Between 2012 and 2020, rate cuts, quantitative easing, and recovering employment reinflated land prices across the U.S. By 2019, median home prices in many markets had exceeded 2006 peaks. A new generation of buyers, who were in high school during the 2008 crisis, entered the market with no experiential memory of the prior stage sequence. By 2021, pandemic stimulus, zero interest rates, and remote work demand drove the fastest land price inflation on record. The pattern had not broken, it had accelerated. Here is what everyone is missing. The reset works because the structural covenants that generate the cycle were never changed. Land remains undertaxed. Appreciation is still captured privately, not returned to the community that created it through public investment and zoning decisions. Credit standards loosen as memories fade, and political pressure for housing affordability drives origination expansion again. Central banks, having caused the trigger with rate hikes, now cause the reinflation with rate cuts. The same tool, the opposite direction. The cycle restarts on schedule. Here is what Stage 5 means for you directly. If you enter during the reset, you are paying a price that reflects two things: the prior cycle's floor appreciation plus the new cycle's early credit premium. You are not getting a good deal because prices recovered from their lows. You are entering Stage 1 of the next sequence. The 18-year clock has reset. The board already knows what stage 4 of the next cycle looks like. They are positioning now. The timeline is faster than anyone wants to admit. Economist Fred Harrison published a book in 2005 called Boom Bust, which predicted the 2008 crash to within 12 months of accuracy, using only cycle timing. No models, no complex derivatives analysis, only the 18-year pattern and a calendar. That book was not widely cited in post-crisis inquiries. The mechanism it described was not taught in economics curricula. The reset validates the system politically. Recovery becomes the institutional defense for why no structural reform was needed. You might be thinking, if this pattern is so consistent, why does no government fix it? Here is the answer, and it is not complicated. The fix is a land value tax, a tax on the unearned location premium that land appreciates toward, rather than on productive output. Every credible land economist knows this. It would eliminate the accumulation incentive that drives stage 1 without touching productive investment. It has never passed at scale in any major economy. The landholder class funds candidates across the political spectrum. The covenant is bipartisan. The fix never reaches a floor vote. Bottom line, 5 stages, 1 pattern, repeating since 1907. The question was never whether the cycle would complete. The question is whether this time, for the first time, enough people recognize stage 5 for what it is before they become stage 4's next cohort. We completed stage 3 between 2022 and 2023. Unknown rate hikes triggered the sharpest affordability collapse in 4 decades. Stage 4 is running now. Institutional acquisition is at scale. The rate cut cycle is beginning. Stage 5 is on the horizon, and it will look, from every angle, exactly like prosperity. Same conference room, same screen, different numbers. That junior analyst in 2005, the one who flagged that land prices had detached from incomes, filed the report and moved on. The cycle did not wait for the report to be read. The 18-year clock does not require anyone to understand it. It does not require coordination. It does not require conspiracy. It requires only that land remains fixed in supply, that credit remains cheaper than appreciation, and that each new generation enters without memory of the last stage 4. The question was never whether the mechanism would run. It was whether anyone would read the term sheet before signing. The clock reset in 2012. It is now 2026. Do the math.